Hello, ladies and gentlemen, and welcome back. Today, we have to discuss this chart. Of course, capitulation happening over the last 24 hours. Everyone is talking about it, and I mean everybody. It is literally trending across the Twitterverse and also a whole bunch of social medias. When everyone thinks something, often other things do occur. But more importantly, we need to discuss the wicks that we saw over the last 24 hours in markets. This all comes into some key bits of news. Let's talk about why this all happened and, of course, what we expect next for stocks, commodities, and cryptos. Well, welcome back, everybody. Let's get started by talking about the macro, the lead news indicators, and of course, then we'll talk about the key levels that you should be watching on the markets right now. So Wall Street tumbled on rate, recession worries, bleak market, chick maker outlooks, and on top of that, we also had a GDP revision showing us the economy might be a little bit hotter than expected. That was really the trigger or the catalyst that started this short. It's unusual for that to occur, but the revision was fairly significant. Over here at our Twitter on FX Evolution, if you're going to follow it, description down below, we posted a few things that I think we should discuss. First up, dumb money versus smart money. Are we seeing any edge here on this chart at the moment? Well, what we have is, of course, smart money continuing to weaken a little bit on its purchases and dumb money buying each one of these rips fairly heavily. Now, if we do rip again and we see dumb money starting to purchase heavily and smart money disagreeing with that, then that's going to be a clear sign that we need to be incredibly careful about rips moving forward. We'll update you. Make sure to follow at FX Evolution if you're interested. The next thing I wanted to bring up was the big difference between stocks right now. As many of you would know, Tesla just got absolutely obliterated over the last week to 2 weeks. We definitely thought that the market would come down to around that 135, 136 level, but then it lost even more. And we've got more on that later on today because I think it's hit probably a capitulation level, and there are some catalysts to say that maybe the market is starting to turn on that one. But first up, let's talk about Apple, because this is the biggest stock in the world and there's a big issue coming into 2023. What is that? It's just too expensive. Let's be frank. Apple is basically a consumer discretionary stock. At the moment, they're having to get out of China and obviously moving their factories. They've got concerns there. And on top of all of this, we've seen many stocks that appears to Apple and other consumer discretionary stocks getting obliterated during 2022. That hasn't happened to the biggest defensive stock in the world in terms of this sector. And if we get new lows, which we haven't yet, we've got to be a little concerned, especially about the sell the rumor, buy the fact style of market that we might be going into during Q1 earnings. More about that later, but certainly one to watch. And Apple is going to be the chart, I believe, of the first quarter during 2023. Let's go over to some stats. As we said, we've got some pretty big areas here. New York Stock Exchange 52-week lows are starting to expand again. Yes, we saw stocks basically coming up with a turning point. Now, we've seen one of these sells during 2022, one of these particular signals, and we just saw it again the other day. Now, it doesn't mean that the market has to instantly sell off, but what it does show us is some stats moving forward. And we've got a few data points here all the way back from the 1930s. So over 100 years of data here, realistically, or getting close to 100 years of data showing us what happens here. So when the SP 500, after a 10-day average of the New York Stock Exchange lows as a percentage of highs and lows from the cycle goes from down 45 to above 65%, we start to get some very worrying stats moving forward over the next week, month, 2 months, 3 months, and even 6 months. Look at this. 3 months later, only 42% of the time the market's up. 1 month later, only a third of the time the market's up. It doesn't bode well for Santa Claus and, of course, the rallies. Speaking of Santa, we did share this stat for any new viewers out there. This is a very interesting one. If Santa Claus rallies don't work, that is, they're negative, and I actually found even if they're a little bit lower than normal, it tends to be very bad for January. Now, remember, Santa Claus rally theoretically happens during and after Christmas into the first 2 days of January. So the first 2 days of the trading year. So we haven't even really seen the start of what they call the Santa Claus rally. But if it doesn't work or it's red, the first Q1 could be very nasty. And this is the types, and even the calendar year. So this is the types of stats that we like to look at. For 2023, anybody that's been watching would know that we're looking at between a 15 and a 17 forward PE ratio. At the moment, the markets are sitting right on 17, which is pretty much what you would call fair value. As we see valuations change, look to the forward PEs. It's going to be one of the better indicators, I think, for 2023 when talking about finding some form of fair market value. Are there any other positive signs? Well, unfortunately, the MACD switch that we saw the other day that we first reported about 2 weeks ago or 1.5 weeks ago still gives us some really bad stats. So this, coupled with what we just saw before, again posts a very bleak outlook, I guess, for the next 1 to 6 months. Things just aren't looking that good when it comes to the S&P 500. Conditional seasonality also shows us that during bear market years, usually Santa doesn't come. At this stage, that seems to be the way it is, though don't discount it yet. There are some reasons we'll talk about today's video that we still may see a rally, and actually it's shored up a level even more than you might think that we discussed in previous sessions. Now, when we're talking about the market, we obviously always want to talk about the VIX. Let's get into the charts. The volatility index bounced off 20, and it had a pretty big bounce, actually. The market freaked out a little bit there with an unexpectedly large move. The VIX was up as much as 20%. We also saw a lot of defensive sectors getting purchased by the market. It was another day where defensive sectors beat out all of the other ones. That means things like XLP, XLV, and other consumer discretionary didn't do very well. Consumer technology didn't do very well. It was really just markets where you were seeing a rotation into the defensive stocks. If we start to see rips, that is, markets move up, and XLP and XLV continue to be the best performers, XLU as well, then we know what's going on. The market's moving into defensives as it sucks retail traders in to a short. Watch the channel. We'll be following that one along the line. Let's have a look at high yield bonds. What happened there? They dropped, but not super considerably. High yield bonds have been showing us the way in 2022. When they've rejected and the market's rejected, it's been a great signal that things are looking very bad. What about treasuries? Well, treasuries held fairly well. A few people wanted me to update this chart. Everyone loves treasuries at the moment. Look, treasuries are coming into the zone. They're basically in our green box. And we theorized that everyone was getting a little bit too hot on treasuries. And now, since the Bank of Japan decision this week, we've seen them drop a little bit. So they're back to a level that's probably more of a fair value at current market and what we're seeing in the markets. In terms of yield, we also saw yields move in the last 24 hours, not considerably, but that GDP revision did make them spike slightly. And you can see both the US 2-year and 10-year were up slightly on the session. A lot of people have been sending me this one, which is the PCC, the put-call ratio chart. You'll notice here that equities plus indices did go out of control. There was a huge amount of supposed puts entered into the system in comparison to calls. Potentially a lot of calls were closed. Who knows exactly what ended up happening here? But that's a fairly large spike. If we put it in comparison, you'll see that it's getting up to our threshold levels. And usually when we've seen things like this, we actually get markets starting to move the way up after. So we see a huge amount of puts suddenly enter, and then we see rallies followed by potentially dumps later on. More on that later on today. Let's move over to the US dollar. This worked, frankly, perfectly. It hit the levels that we've been talking about, that 61.8, and we saw very nice movements. It went back above 104 and it's pulled back at this stage. It looks like the US dollar might be able to continue its strength. The first rally was very good. That put pressure on, of course, gold, which we'll talk about in a second. And we're looking now at a breakout past around that 104.50. And if that occurs, then we probably move back to that 105.20 zone. So DXY had a fairly strong day. Let's have a look at the daily close on it. You'll notice here, nice wick rejection with the strong bullish close. That's usually a fairly decent sign. And again, it's in line with what we've discussed now for a few days here for the DXY. Great session, actually, for currency and gold traders. Speaking of gold, look, we held it in terms of our our ideas, and it ended up playing out. The market has sold off to a key zone. Probably expect the market now to rally a little bit on gold and then potentially drop after that. But this was the big one. Of course, we thought that gold would short through this 1803. It came up, it did a distribution with the false break up here. Didn't go past the high, so there was no new high. And that's very important. And then, of course, we saw a drop, fall all the way back down to this level, and we find ourselves where we are right now, which is probably a little bit of recovery into hopefully further shorting if the DXY can hold up. Very interesting chart, gold showing us what it's worth this week. Also remember that we're about to come into the Friday close. Now, if gold can manage another bearish session like this actually opens up two very interesting trades. If we end up closing bullish above here, get ready for some serious rips on gold because that will trap a lot of people. At this stage, it looks like it's trying to kind of like turn over towards the downside as we're getting those wick rejections. But remember, this is a doji, this is a long leg doji, this is to be determined. So we don't know what it's going to look like. It might go like this, make another doji. Once we see a closure to either side, we know whether the bulls or the bears have won this position. And at this stage, all we know it's a super critical point for gold, and there's a lot of orders being placed on both ends. Let's move over to oil. Oil did continue the rally for part of the session, then fell, and it's come back down to roll reversal. So that's resistances becoming supports. We saw a breakout of the downward trend, which made us think that 82 is now a possibility. I think we probably continue to believe that 82 a barrel seems to be the current conditional for oil leading into Christmas. And then ideally we move down and of course hit that eventual target of 65 during 2023. What do you guys think in the comments down below? Let me know. Let's talk about the big elephant in the room, and that's Tesla. It was a shocker. Another shocking day. 8.88% down. It was down even more than that at one point. Very bad session. Let's have a look from the close to the low. We went down as much as 11%. You know, this whole Twitter Elon fiasco is really becoming a big issue, I guess. But was that capitulation? Let's put things in perspective. It's not the biggest weekly close we've ever seen, but certainly it's one of the biggest runs that we've had on Tesla. And this has been from top to bottom now. If you can believe it, from the top here, we are now down around 70% from the lows. That's pretty bad. And of course, nobody likes to see these types of stocks this low unless you're a shorter. So we thought that we'd close the gap. That was sitting around that 136 zone. Around here, yeah, I would have thought that there's probably going to be some form of buyers. It made sense to the options chain as well. But in typical capitulation style, because we had no reason to actually see a turnaround, the market just continued to fall. Everyone's talking about this now. It must be pretty close to the lows purely because people are talking about it. Now, that doesn't mean it doesn't go lower later on. It just means that there's probably due a rally. Why couldn't it rally is the question that everyone needs to be thinking about, though. And the answer is simple. Too many people buying calls. Look at this. So many calls opened. It was just a bonanza this week for the market makers. We almost got to 1 million units from pretty small at the beginning. Max Pain sitting at 145. Obviously, stock price is well under that at the time of this recording. But you can really see that it was just calls going on everywhere in Tesla. And as we move forward into 2023, you'll also notice that we have 3 million units sitting on the 20th of January. So this is going to be a very interesting point. And if you think about it, at this stage, it would actually make sense that by that time, Tesla would be higher than where it is right now, based on, of course, just the options and what we're seeing. Now, we did have a market bounce. We also saw Elon come out and claim that he wasn't going to sell any more stocks until the back end of 24 or 25, I think. It was like 18 to 24 months away. And while that's interesting, he has said something similar before and, of course, then been selling his stocks after that point. I do think this is very systematic to capitulation. Capitulation style trading is incredibly hard. Buying dips like this, you have to have an unwavering hand and have to believe in something and have a system around it. So do we have any turnaround actual signals yet? The only one I could find was really small time frame where we actually did see, and we haven't really seen it yet, but the post market's done it, which is a market where it's kind of found a base, tested a resistance, and then potentially broken through that. Look at this sell-off. It really didn't do that at any other time for this entire sell-off. We haven't actually broken to a previous high. So if you can believe it, yeah, this is the first time that Tesla's even shown any signs of potential recovery. Let's move over to Apple. It held its low. That's a good sign, theoretically, for the market to potentially bounce. Let's have a look at the daily here to put it in perspective. Little wick here at the end. That's going to be important when we take a look at some other stuff later on. And we still kind of maintain that there's a real chance of this occurring. Although we're bearish on the market, don't get me wrong, I still think that there could be a rally that comes through. We expected weakness in the last session. I thought that we'd gap close and then find buyers. We'll talk about that in a second, but we ended up just continuing down. And that would have been brutal for people that weren't trading options and didn't have stop losses and those types of things, because it was a sneaky day. It took out a lot of people's low stop losses, and I'm sure a few people watching, unfortunately, would have been hit by that. Let's have a look at Apple versus the S&P 500. Again, this ratio is still holding. If this breaks, watch out down below. Biggest stock in the world, of course, will have big ramifications to the market. Consumer discretionary versus staples, absolutely shocking. We reported on this a few weeks ago that it looked terrible again, and it just continuously looks weak. Remember, 1/3 of the US economy is the American consumer, and it's not healthy. The market is showing that it's concerned heavily about Q1 earnings. Could it be the sell the rumor, buy the fact style market at that point? Now, the international markets held way better. Look at the DAX here. The DAX broke through, came back to a nice little pickup level, and actually started to buy off that zone. This is a great technical. It's much better. In fact, it looks more towards that bullish side with hopefully bears coming in later on. But it wasn't the same for all of the US markets. The Dow, again, didn't make a new low. The Dow was okay. The Dow breached all these levels, came back, extreme kind of looking lows, and actually found the rally. A new high from this point should detail a few very key points we'll discuss, but we cannot lose sight of the fact that this is most likely distribution. And because it's distribution, we've got some problems with the market moving forward. And I can't discount what happened here during that CPI number. That was a serious wick rejection. It has to make us feel bearish about markets in general. Speaking of bearish, everyone hated the tech sector in the last session. You'll notice there is a wick rejection near the close, but realistically, Tesla, semiconductors, a whole bunch of stocks were getting hit very heavily. We've got alerts set at 11,300. Should that level be reached, then you've got to basically think that the markets are probably going to rally and keep rallying. Of course, this will be a critical zone, but we'll talk about the S&P 500 to find out some more information. So at this point, the tech sector is clearly the weakest in these rallies. It may have a bonanza session, but I think that's more of a trap than anything else. Earnings, valuations, and compression are definitely the way the market is trading at this stage. Let's move over to the US 500. We'll actually use the SPX to start off with, the real market. I've marked out some gaps here. So we have a gap now unfilled from 38.78. The previous session, we had one at 38.22, which is funnily enough where it actually closed. So this was where I thought the market would pull back down to and find buyers. It didn't find them here. It went lower, got really close to filling that 37.47 gap, and then found some serious buyers by the end of the session. And I think it's where the buyers came in. So remember, we've got a gap still above 38.78 and that 39.94 one. So let's have a look now at the back end of the session, and more importantly, the last, like these 5-minute candles here. Notice where the buying came in, pretty much that last 2 hours. This tends to be where Wall Street places their positionals. So while at the beginning of a session, usually retail's sitting there, at the back of the session, we often say the close is the key. Wall Street might be there. If we put this in perspective on the weekly, it still actually looks like a nice rejection wick. And the daily at this stage looks like a fantastic rejection wick. So if this is backed up by a bullish candle, you've got to think this is a real possibility, 39.94. I know it won't feel like that now, but this wick is fairly important. I think that's a fairly big deal. Let's have a look now at the US 500. So our original thought process was this, this potential sell-off here. Let's have a look if that still plays out. I'm going to move the fib down to the low. And what you might notice is the fib actually now sits on the unfilled gap level. Yeah, that's pretty cool, like that it's sitting there. So I'm not actually too scared by what has occurred. Let's go down to the 2 hour, have a look at it. So we did alert this was a problematic zone. I didn't think it would fall as much as it did, but of course, 38.20 made some sense. Then we expected some kind of rally up. Now it took the lows. This will have trapped so many people into shorts and so many stop losses will have been hit. I cannot tell you. I'm sure you know someone, maybe it's yourself, that would have been hit up in this area. Now, because there was a rally, you might have to believe that there could be continuous rally through the next session. The next 24 hours is really important. Core PCE price index is coming out. Maybe that will be the catalyst. Be very careful at the 38.80 to 39.10 zone. That's going to be a really big issue zone. If we breach past 39.10, you've got to at that point think that 4,000 level or 39.95 is very possible. For bears, all you want is a new low. You get a new low, well, next week is not probably going to bring the Santa Claus. So next 24 hours, incredibly important to markets. And at this stage, we like the end of day rally. That's probably the best thing that we can see there. If we have a look at the options chain coming in, 385 is max pain. Current stock price is 380. The reason we thought 390 as well might be a problem was these calls sitting on top of it. And that still remains. I doubt it can get too much above 390, even if it does have a super rally through the Friday session, because this is to a degree holding it back. It's nowhere near the amount of normal options, but there's a little bit there. So let's now take a look at what's going on into the end of the year. And you'll notice there's a ton of 360 puts, so you can't expect the markets to get too walloped down below 360 and 365. And the call side, you're looking at that 400 being the first big call. So pretty much in line with what we've been discussing. Let's move over now to crypto and Bitcoin. It actually pulled back perfectly. Again, Bitcoin was actually nicer. It pulled back right to the zone. Effectively, you'll see this is now as maybe an inverse head and shoulders. Obviously, a breach of here should push into that 17.5, 17.6 zone. So crypto, if you believe it's a precursor, starting to look a lot better on the charts. Certainly worth a watch. Now, in terms of data coming out, we know it's core PCE price index. That is 8:30 a.m. New York time on Friday. Make sure to be careful around this time, guys. And do remember, in the Christmas week, that is the Santa Claus rally week, you tend to see a lot less liquidity. So be very careful about illiquidity in certain pairs. Currencies and also commodities can have very large spreads. And I caution you to always look at your bid and ask on the broker to make sure you don't get stuffed over by some massive spread. Take it from my opinion. I've had some times where I've seen upwards of $10, $20, even $30 an ounce spreads on gold. And that can get very brutal depending on your contract size. You click a button, you make a mistake, bad things happen. If you enjoyed today's video, remember to go and follow us at FX Evolution on Twitter. Of course, make sure to hit the subscribe button, smash the like button, and we'll see you in the next one. Bye for now.